This is Nick here for Merk Research, and I'm about to go through some highlights from my chart book on the U.S. business cycle. I'll try to go through them more quickly in this video. If you need context on the charts, I'd recommend looking at the December video where I go into the background of each chart, what my framework is, and why I think it's important. Like last time, I'll start with my conclusion, which is that for the time being, which is roughly a 6-month forward-looking time window, I see an all-clear signal on the U.S. economy. In other words, I don't see a recession as imminent. And when I say that I don't see a recession as imminent, that's not to say that there are not some trouble signs out there or that there aren't some capital misallocations brewing under the surface. There will be a downturn at some point. Many of those issues will come to the surface. My goal here is to try to add an element of timing, and as part of that, go through these business cycle charts. More market related, I'll publish a presentation on the highlights from my S&P 500 chart book next week. Today I have 6 charts to go over. I'll talk about each, and to the extent that I'm positive on the chart, I'll talk about what would get me negative. So with that, let's start with the first chart here. This is the Conference Board's Leading Economic Indicators Index year-over-year rate of change. The latest reading has come in at plus 5.5. That's up from a reading of plus 5.2. This is a monthly data series. So the LEIs are accelerating higher, which is a positive sign for the U.S. economy in the near term. Obviously, given the framework that I established in my initial presentation, I am still positive on this chart. The picture has improved from up 5.2 to up 5.5. To reiterate from last time, what would get me negative on this chart is to see a reading of 0.0 or negative. Moving on to the U.S. yield curve steepness. In general, yield curve steepness is a longer-term U.S. Treasury yield minus a shorter-term U.S. Treasury yield. In the previous video, I go into much greater depth on this concept, but in any case, here is the 10-year yield minus the 3-year yield. We're just a little bit below the historical average. So going back, if you were to take all these data points, going back to 1963, the average level of steepness is right around 61 basis points. So currently, we are below that, but I would say only slightly below that. Clearly on a flattening trend, but that's been going on for years. I think the media attention on this recently is somewhat overblown. My base case scenario is that eventually we will go inverted on the yield curve, meaning that this line will be below 0.00. That would mean that the U.S. 3-year yield is higher than the U.S. 10-year yield. And I think that that will act as a leading indicator as it has in the past. So what would get me negative on this chart is to see a flat or inverted yield curve. Here's an update on the U.S. PMIs. The manufacturing PMIs in black ticked up in the latest reading, and it's generally at or near multi-decade highs, currently at 59.7. That's a very strong sign for the economy. The services PMI in gray fell for the December reading. That's at 55.9, but still well above the 50 level, which is the dividing line between expansion and contraction. Overall, still positive on this picture. This goes back to the framework established in the initial video on the business cycle, What would get me negative is to see the manufacturing PMIs, which is the black line, fall below 50. I didn't show this chart last time, so let me take a little bit of time here to introduce it. This is a chart showing global manufacturing PMIs. So we just went through the U.S. PMIs, which was both manufacturing and services. This is focusing on manufacturing PMIs, but from around the world. I think it's extremely important in terms of understanding the U.S. economy and the U.S. equity market to put things into a global context, which is really where they need to be. My framework here, why I think this is important, is that the global economy is highly integrated. So when thinking about economic prospects for the U.S., it's important to look at what's going on in the rest of the world. This chart, as you can see, goes back several years, and currently looking at the manufacturing PMIs among the U.S., China, Japan, Germany, the U.K., India, France, Brazil, Italy, Canada, Australia, and even a few others, all are in expansionary territory. All of the readings are above 50. So that's a very positive global backdrop for the U.S. expansion. By some accounts, this is the most globally synchronized expansion on record. What would get me cautious on this chart is to see any of the U.S., China, Japan, or Germany fall below 50. Those are the four largest economies in the world. To see any of those fall below 50 would be a sign of caution. As a side note, as you can see, some of these lines don't go back before 2015. That's because these particular data series weren't created until that date, so they don't go back earlier. Another chart that I didn't show last time, so let me take a moment to introduce it. This is generally a way of looking at U.S. labor market slack. What we're looking at here on the black line is the U3 unemployment rate. That's the headline unemployment rate for the U.S. that you hear on the news. The jobs report, which just came out, had the rate steady at 4.1%. The gray line here is the 12-month moving average of the U3 unemployment rate, and that's currently standing at 4.3%. When the black line crosses above the gray line, that's a warning sign for an impending recession. Now, the blue line here is the 10-month moving average of the labor force participation rate. That has been trending higher, as you can see here, from late 2015, which is a healthy sign for the economy. Now, as that turns lower, for example, if you look at the last cycle, as that labor force participation rate generally trends lower, while the unemployment rate ticks higher and through that 12-month moving average of itself, that has been a strong indication that the cycle is almost over. Right now, the picture looks fine to me. The current reading at 4.1 is below its moving average of 4.3, and the labor force participation rate is currently trending higher still. So right now, the picture looks fine. No warning signs here yet. What would get me negative is to see the U3 rate, which is the black line here, cross above that moving average in gray, while this labor force participation rate moving average starts to trend lower. That would be a negative sign. That would be a sign that labor market slack is being exhausted. As a general point, labor market slack getting exhausted is an excellent indicator for the end of a cycle. This is just one way to look at it, and I plan to show some other ways in future presentations. But let me just say, in summary, that those other charts that I look at with respect to labor market slack aren't showing warning signs. In other words, indicates that there's still slack yet to come out of the labor market, which means that for the time being, expansion is likely to continue. This one I call the San Francisco Fed Leading U3 Model. It's based on a paper that was published by the San Francisco Fed along with the details of their model. And the model that they have is really meant to be a leading indicator for what is happening with the U3 unemployment rate. So the San Francisco Fed model is this dotted black line here that's at negative 1.1 currently. It is a leading indicator of this. The solid black line, which is at 4.1%, that's the same U3 rate that we just looked at on the previous chart. These gray bars here are the year-over-year change in the U3 model line. This, as an indicator, can be a little bit early, so it should be taken in the context of other indicators. But currently, the picture looks positive. The model indicates that the U3 rate should continue to decline. I would not be surprised to see some readings this year on the U3 rate that are 3.9% or lower at some point within this year. What would get me cautious on this chart is to see this year-over-year change go above the zero line here if these gray bars were positive and this dotted black line, which is the U3 model, was ticking higher. Those things, that picture would get me cautious on this particular chart. All right, so in conclusion, we've looked at leading economic indicators, yield curve steepness, PMIs, global growth, and the labor market. As I've said, these charts and concepts are somewhat interrelated, as is the economy in general. So the idea is to have some different data points to cross-reference. As I said at the beginning, on balance, the data to me suggests that the expansion will continue over the coming 6 months and in general until further notice. I've talked about what would get me negative on each of these charts. So going forward, I'll come back, update the data, and provide an update. If you'd like an updated copy of those charts, you can send a request to info@merkinvestments.com. Looking ahead, I plan to publish a presentation on my S&P 500 chart book in the next week or so. If you found this presentation insightful, please share and subscribe.